Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about the negative jobs data we got this week and how that's impacting rates. As always, I want to thank our sponsor, Trust and Will, for making this episode possible. Logan, welcome back to the podcast.
It is wonderful to be here. And of course, yesterday we talked about Jobs Week and previewing it. And technically, Jobs Week is over, right? We're going to get the BLS jobs report next week. But again, to me, we have all this talk about growth and inflation and Kevin Warsh and anything. But whenever the labor data gets weak, 10-year yield just drops. And this is Thursday morning. And I think this is a good test case of how to explain, for me personally, after 2010, after qualified mortgage came into play, which values the mortgage buyer a little bit more with credence because, qualified mortgage made sure that everyone's legit. The housing market data really revolves around the 10-year yield, just like the slow dance, how we always talk about the slow dance with the 30-year mortgage rate. But because the qualified mortgage was put in, it really puts a little bit more emphasis on mortgage demand being the big driver. But even though we didn't have jobs week fully, let's review every single one. ADP report, weaker than estimates. The jobless claims data spiked. I would say that's the winter storm because it's majority coming from places where winter was very heavy and people were kind of blocked in their house. Number three, the job openings, the headline job openings data missed the estimates by a lot, but the internals were just mostly the same. Softer labor market, no hirings in big fashion, no firings. But then we get into the Revlio data. Revlio Labs is one of those new private sector jobs things, and that even showed a negative report. So with everything in play, with GDP growth up and inflation above target still, all this talk, and the 10-year yield fell noticeably after a weak labor report, that multiple labor reports that doesn't even have to do with Jobs Friday yet.
Okay, so from your perspective, is that the right call, or do you think that people are that the market is overreacting to what these labor reports say?
In the past, in 2023, the Gandalf line, we said, we're not going into recession, we shouldn't be here. That was warranted, right? The reversal in yields. 2024, when the Hodor line at 380, when it broke and people thought the job market wasn't breaking. Now it's different. And it's different, I would say, in one of the more prominent times in history, because last year, treasury supply, inflation, all these things were supposed to keep yields higher, but the 10-year yield went all the way down to like 3.95% even. But here it becomes, I got to tell you, it has to be confusing for the public or people in the real estate industry. Here you have a very unique situation. You have the lowest job growth in the 21st century, but you don't have big fires yet. You don't have a lot of hires going on. You have negative revisions. We have trade wars. We have tariffs. We have all these things going on, but we don't have that big layoff. And yet we have GDP growth still positive, consumption still holding up. So I believe the 10-year yield is trading more disciplined now in 2025 and in early 2026, because we're talking about it. The last time I saw was 421 on the 10-year yield. The last time I saw mortgage rates getting down to 6.17%. But if you believe in neutral policy like the Federal Reserve does, this is kind of the low end range of what neutral policy would be like, even with spreads being almost back to normal. So kind of, I think it looks perfectly normal. But I think it's confusing for everyone because people are anticipating like the Fed to really cut rates and maybe rates go lower. But this Federal Reserve, the governors, do not believe getting to neutral policy as fast as they can is the right way, because to them, they just see inflation above target and the labor market isn't breaking, which goes back to our 2022 premise that if you want the Fed to really pivot, like a lot of people want, and rates to go sub 6% and make that next leg lower, the labor market has to break, and jobless claims isn't breaking. And the Challenger report, which is another data line, that had the highest layoff announcements since 2009. But that's a very, very small labor pool data line to track. So the Fed doesn't really put too much weight on that.
So the Fed is always looking at jobless claims, right? But what you're saying is like, we're not seeing hirings, but we're not seeing firings. So won't that won't that sort of suppress the index that they look at?
Well, to me, like the job openings data, they like it because they measure the breadth of the labor pool. Like when job openings were at 12 million, they didn't like that because employers have too much power. They can quit their jobs and get higher wages, and wages go up, and inflation gets more sticky. But here, the job openings are finally well below enough from pre-COVID levels, but wage growth is still above 3%. So I think they just feel like, and they've said this a lot, it's softer, but it's not breaking. Who else uses that term? We've said it for like 24 months now. The labor market's getting softer, but it's not breaking. So it really is kind of what your cup of tea is. Some people would say, like Christopher Waller and them, hey, listen, we need to get down to neutral as fast as possible, because if something happens and the labor market starts to break, we need to get into like the accommodative stance faster. Some people just say, hey, listen, inflation is above target, consumption is good, GDP still growing. It's just one of those really, really strange cycles where you see good growth, but you don't see much hirings. And this can't be all labor force, right? Where we have to like evolve from this labor force growth is slowing down, and that's why we can't get jobs. There are sectors of the economy that aren't really booming, and because of that, their labor pool isn't really growing as much. And we would see that in a normal expansion, like when jobs are growing and revisions are positive, that these sectors kind of participate.
Okay, well, let's talk about housing as a sector, right? Because we know we drive a lot of the economy, but at the same time, the Fed doesn't care about housing. You've said that many times.
Because, for example, let's take some labor pools. The construction workers, especially contract trade, they've been losing jobs for a few months. The residential construction workers that I track a lot, that, typically this data line fades, that data line has gotten softer after the revisions. So it's kind of like that one theme we've had since 2022. They are going to stay as restrictive as they possibly can until the labor market break. And then they'll play catch up. Like, the Beth Hammocks of the world literally told people in public, well, the labor market's softening, but we don't think it's breaking. If something breaks, we'll play catch up. We'll be more aggressive. But it's confusing. I totally get it. You see these 4% GDP prints, but manufacturing jobs have been losing jobs since early 2023. We don't see housing starts and permits growing. That's what you would traditionally see in a cycle, because they see now policy slightly above neutral, like, just barely restrictive to a degree. But here it is. I mean, this is legitimate. This is now, we're going into February, and the January data, you can make some cases the snow is part of it or to that degree, but we haven't seen the reacceleration rate, but rates are, to me, properly priced, with a Federal Reserve chairman and most of their governors still saying it's okay to take our time with the last 2 or 3 rate cuts, because things aren't breaking yet.
Okay, so one of the things that we've really been in the housing market excited about is that we have less volatility with rates. So you feel like we're about where we should be. Do you feel like we can keep this for a while?
Yeah, I mean, that's the one benefit of having spreads get back to normal. Again, spreads being normal is kind of how things usually operate. We've just had an elevated level of spreads for so long. So again, the only way I have the 10-year yield getting up to 440 or 460 is that the labor data has to reaccelerate, right? So we're kind of stuck. We've been stuck in this area that I call it the little bowl with the 10-year yield since the start of January or start of September. And we've just been at this lower level. This is the lower end level of the 10-year yield forecast and the lower end level of the mortgage rate range. So, I mean, it looks right to me. I think some people are just frustrated because they think that the Fed should be doing more. And then now they hear Kevin Warsh is going to come in and he's going to do rate cuts. And Trump said he wouldn't have got the job if he wasn't going to do rate cuts. But the 10-year yield had been going up. But whenever labor gets weaker, It's like 6 data lines. They're all weak. 10-year yield makes a fall, stocks fall off a little bit, money goes into bonds. Even though inflation is above target, still, the labor data ran the show in 2023, 2024, 2025. And so far in 2026, it's still running the show. Now, if all these data lines were reversed, let's say all of them beat estimates. Let's say jobs Friday came in, there's 125,000 jobs created, unemployment rate fell, then yields can go up a little bit higher. But there's a lot of rate cuts in the system, spreads are good. So we just, again, focus labor data. And Thursday morning was a good, there's basically, you could take 6 reports all into one. We just don't have the BLS jobs Friday report here. And that really pushed it. So a lot of talk about treasury supply, inflation above target, all that stuff. But whenever labor gets, money goes into bonds.
So we still, we know that a change is coming, but Powell is still there. Does any of this influence him? Any of these 6 labor reports that are negative?
If they weren't influenced enough with the last few months of 2025, then this is not going to really move their needle. These data line prints have been here for some time. In their eyes, how they would, if they were here on our podcast, they would say, we haven't seen much deterioration from the weak levels. Yeah, when Powell said the labor market is, getting softer, there's some problem there. So again, if the labor market data, which was getting softer, wasn't big enough for them to move, then here we are, kind of the same story. Just remember that the jobless claims data is their number one data line. That's really runs the show. And the spike that we saw just looks like it was a snowstorm. So it's frustrating for a lot of people. I get it, but this is how the Fed has operated because what was it? The spiking of the eggnog.
Oh, right. Who spiked the Fed's eggnog?
Whoever spiked the Fed's eggnog in December really changed everything. And here's a great example. I mean, we are literally 21st century lows in jobs creation. Some of these data lines are negative, and they're just like, we're slowly going to get to neutral policy, So it's a very unique cycle in that front. There's a lot of things that are happening. There's a lot of deficit spending. There's a lot of AI spending out here, data centers being built, stuff like this that, there's always a few subsectors of the economy that go into a recession. And then, most people are always working, but, those sectors just aren't deteriorating big enough to bring the whole economic cycle into what we traditionally see as a recession.
Okay, so that was Powell. What about Warsh? Is there? I know he's not confirmed yet. We're not even sure how that's going to work because of that whole DOJ thing. But is there anything he can do right now to influence things?
If I was Kevin Warsh, which I don't think he'll do this because Trump wouldn't let him do it, I'll just say, hey, listen, Jerome Powell, Beth Hammack, Lori Logan, Neil Kashkari, Austin Goolsbee, these people are behind the curve. And the reason I say this is Warsh did come on national TV and say, well, housing's in a recession. We need to get that back going. If I were them, I would frame it that way, right? Frame it that, I would say traditionally in an economic expansion, housing permits grow, housing starts grow, we get more home sales, the multiplier impact in housing kicks out, and that can generate more jobs. So the one area where the Federal Reserve does control a sector of the economy is housing. In that, you can frame it that way. Just know there's limits to what you can do with rates. You're not going to get rates to 3 or 4 or even at 5%. So that's how I would frame it and keep that battle going. But hypothetically speaking, if the labor data reverses and things get better, it also puts him in a box about cutting rates in any big way. So it's a delicate act right now. But now that you have Warsh in, if you really wanted to go after Powell and the Beth Hammacks of the world and these, you just kind of go into in that, be the shadow Fed president out there and talk that. But Warsh has some really weird takes, and the White House is already talking about reducing the balance sheet, and that confuses a lot of people. And, we kind of joked that, this morning, what if Warsh keeps on wants to cut rates, and the 10-year yield goes higher? Then I joke that, Trump's going to yell at him to do QE, and the Federal Reserve has already said they're not going to do quantitative easing unless we're at zero interest rate policy. So it's going to get very interesting, but it's also, I think this is very confusing for a lot of people because we've always had a Federal Reserve that's, in the past, kind of, if the labor market was like this, we'd already be in neutral policy. So there's a fight here, for sure. And it's just February 2026,
It's only February, and good timing. Our Housing Economic Summit next week, you guys. If you guys have not yet secured a spot, those seats are filling up. Come and hear some of the best economic minds, especially on housing, in the country at the same place at the same time. It's going to be amazing. Logan, of course, will be there. So, Logan, thanks for walking us through all of the complexities.
Pleasure, Sarah. And what fortuitous timing for that event, right? Because we're going to have a lot of different takes. And, once we get this snowstorm out of the data pool for housing, we could go back into that. But interesting. I mean, every week it's been what a week, and we have one more day left, and we're probably going to say that again. What a week, and we'll just take it from there.
Thank you.